In 1969, a Fidelity study quietly found something that most financial advisors still haven't fully explained to their clients. The investors with the best long-term returns weren't the most active ones. They were the ones who had simply forgotten they had accounts. Not because they were lazy, because they stopped interfering. Most people understand compounding as a concept. Returns build on returns. Time does the work. That part is correct. But there's a version of this that goes several layers deeper, one where compounding isn't just a single process you wait on. It's 4 distinct mechanisms running at the same time, each one amplifying the others. Here's what that gap actually costs you. Running only one of these engines for 30 years doesn't get you a quarter of the result. It gets you a fraction of a fraction, because the real acceleration only happens when the engines work together. That's what this video is about. My name is Alex, and if you've ever felt like your investments are growing but not fast enough, consider hitting subscribe before this video ends, because compounding isn't one thing you either have or don't have. And I'm going to show you the 4 specific mechanisms that drive it and exactly how they interact when they run in parallel. Once you understand how the system actually works, you won't just think differently about your portfolio. You'll look at every investment decision through a completely different lens. The pattern that makes this possible traces back to one mechanism most investors activate by accident, if at all, and it starts with what happens to the money your investments are already generating right now, and every quarter sitting idle in your account. That's the snowball effect. Most people think the hardest part of investing is picking the right asset. It isn't. The hardest part is resisting the urge to do something with the money once it starts working. Here's why that matters. Every quarter, millions of investors receive dividend payments from the stocks and funds they hold. A little cash lands in the account. And almost universally, it just sits there. Not because people are making a deliberate choice to let it idle, because the default setting on most brokerage accounts is cash delivery. The dividend comes in, it parks itself, and it waits for you to do something with it that you probably never get around to doing. That default setting is costing people a significant amount of money over time, not in a dramatic, obvious way, in a quiet, compounding way that only becomes visible 30 years later. Here's how the mechanism actually works. When you enable dividend reinvestment, most brokerages call it a DRIP, a dividend reinvestment plan, every dividend payment you receive automatically purchases additional shares of the same investment. Not cash sitting in your account, more shares. And those new shares immediately begin generating their own dividends, which buy more shares, which generate more dividends. It's a loop, a self-funding loop that runs completely in the background, requiring nothing from you after the initial setup. Now you're probably thinking, how much does that actually add up to? The numbers are more significant than most people expect. Take someone who works as a project manager in her early 30s. She's been putting money aside consistently, which is already more than most people manage. She puts $94,000 into a diversified dividend portfolio, something like a mix of SCHD, which is the Schwab U.S. Dividend Equity ETF, and Realty Income, a real estate investment trust that has paid monthly dividends for decades. Then she does one thing. She logs into her brokerage and switches on DRIP. That's it. No monthly contributions, no market timing, no rebalancing strategy. She doesn't add a single dollar after that initial investment. After 10 years, that $94,000 has grown to roughly $330,000. After 20 years, she crosses $1 million. After 30 years, the account sits at approximately $3.7 million. Let that settle for a second. She contributed $94,000 total. The other $3.6 million came entirely from reinvested dividends compounding on themselves over time. She didn't generate that wealth by working harder. She generated it by not interrupting a process that was already running. This is what makes the snowball effect genuinely different from just holding an investment and hoping it appreciates. Price appreciation is unpredictable. Dividends from well-established companies are far more stable. SCHD, for example, has delivered consistent dividend growth, averaging around 10 to 11% annually over the past decade, and Realty Income has increased its dividend for over 25 consecutive years. You're not betting on a stock going up. You're betting on a machine that has already demonstrated it knows how to run. And look, I'm not saying this works identically for everyone, or that every dividend stock is a safe hold forever. Companies cut dividends. Sectors fall out of favor. The math here assumes a reasonably stable portfolio, and that assumption deserves some honesty. But the underlying mechanism, reinvested income generating its own income, is one of the most durable forces in personal finance. It doesn't require you to be right about the market. It just requires you not to turn it off. The setup takes less than 15 minutes. You log in, find the dividend reinvestment option in your account settings, enable it across your holdings, and then you leave it alone. The snowball starts rolling the moment the next dividend is paid. One engine running. But here's the thing. The snowball effect works best when it has time. A lot of time. And that brings up a question worth sitting with. What is time actually worth, in dollar terms, to an investor who knows how to use it? Because the answer is not what most people assume. That's exactly what the silent force reveals. There is a number that almost never appears in financial media, and it might be the most important number in investing. It isn't a return percentage. It isn't a price-to-earnings ratio. It's a date. Specifically, the date you started. Think about what that implies. Two people invest in the exact same fund, generating the exact same annual return. One starts at 28, the other starts at 38. By retirement, the gap between their outcomes isn't 10% or 20%. It can be several $100,000, sometimes more, from a single decade of difference. Not because of skill, not because of strategy, because of when the clock started. This is the silent force. And it's the one engine most investors underestimate because it doesn't feel like a strategy. It feels like waiting. And waiting doesn't feel productive. That's the psychological trap buried inside one of the most powerful mechanisms in finance. Here's how it actually works. The S&P 500, the index that tracks the 500 largest publicly traded companies in the United States, has returned an average of roughly 10 to 10.5% annually over the past 30 years, accounting for dividends. That number has survived recessions, crashes, pandemics, and interest rate cycles. It has not been smooth. There have been years where the index dropped 30% and years where it gained 30%. But zoom out far enough, and the line goes up, consistently. The reason is simple. Over long enough time horizons, the underlying earnings of American businesses keep growing. Compounding amplifies that growth. And every year you stay invested, you're not just earning on your original capital, you're earning on every previous year's gains as well. The base keeps expanding. The returns compound on a larger and larger number. That's not a metaphor, that's arithmetic. Now let's make it concrete. Consider a software engineer in his mid-30s. He's reasonably diligent about money. He puts $94,000 into a straightforward two-fund combination, the Vanguard S&P 500 ETF, known as VOO, and a position in a large-cap individual stock with a long growth track record. Then he does something that sounds almost too simple to be a real strategy. He holds it. He doesn't trade in and out during downturns. He doesn't rotate into sectors that are currently in the news. He doesn't panic when the market drops 15% in a quarter, even though every instinct in that moment is telling him to do something. He just holds it for 30 years. The result depends significantly on what that individual stock does. If it tracks something close to broad market performance, the outcome is still substantial. A portfolio that started at $94,000, growing at roughly 10% annually for 3 decades, becomes approximately $1.6 million. That's without adding a single cent after the initial investment. If the individual stock significantly outperforms, the way certain large-cap technology companies have over the past 2 decades, the number becomes dramatically larger. The principle, though, is the same in either scenario. Time did the work. Here's the part worth sitting with. Most investors intellectually accept that long-term holding is the right approach, and then they don't do it. The average holding period for an individual stock in the United States, as of 2025, is under a year. Under a year in an instrument designed to reward decades of patience. People understand the strategy and still can't execute it because the market generates an almost continuous stream of reasons to act. A bad earnings report, a rate decision, a geopolitical event, an analyst downgrade. The news cycle is optimized to feel urgent. Patient investing is optimized to feel boring. That tension doesn't resolve on its own. You have to consciously choose the boring option, repeatedly, for years. And that is genuinely hard. Not technically hard, behaviorally hard. And the silent force requires the one thing modern life is specifically designed to make difficult: the ability to do nothing and trust the process. The investors who manage it don't necessarily have better information. They just have a clearer understanding of what the game actually rewards. Holding is one part of that equation. But what happens when you stop relying on a single lump sum and instead turn your monthly income into a recurring growth engine. That's where the Monthly Accelerator changes the math entirely. Volatility kills most investors, not because it wipes out their accounts, though that happens, but because it breaks their nerve right before the recovery. They sell during the drop, miss the rebound, and then spend years trying to figure out how to get back in. The irony is that volatility, handled correctly, is not the enemy. It's actually one of the most reliable wealth-building inputs you have. You just need the right mechanism to convert it. That mechanism is called dollar cost averaging. And while the name sounds technical, the concept is almost aggressively simple. You invest a fixed amount of money on a regular schedule, say the first of every month, regardless of what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, the same fixed amount buys more. Over time, this naturally lowers your average cost per share. You don't need to predict market movements. You don't need to watch charts. You just need to keep showing up on schedule. Here's why this matters more than most people appreciate. The investors who consistently outperform over long periods aren't usually the ones who made brilliant calls at market peaks and troughs. They're the ones who kept investing when the market looked terrible. October 2022, when the S&P 500 was down over 20% for the year, was an extraordinary buying opportunity in hindsight. The people who recognized it in real time and acted on it weren't necessarily smarter. They just had a system that kept them investing when the emotional logic said, stop. Dollar cost averaging is that system. It removes the decision entirely. Let's put some real numbers to this. Picture a marketing director in her early 40s. She already has a foundation in place, $94,000 invested in a diversified dividend growth portfolio, something like a combination of DGRO, the iShares Core Dividend Growth ETF, and a blue-chip consumer staples stock with a long track record of stable returns. Then she does one additional thing. She sets up an automatic transfer of $1,000 every month into that same portfolio. She doesn't adjust it when the market is up. She doesn't pause it when the headlines are alarming. She doesn't double it when things look promising. $1,000 every month automatically. By year 20, her portfolio is approaching $2 million. By year 30, it's sitting at approximately $4.4 million. Now here's the number that puts the whole thing in perspective. Over those 30 years, she contributed a total of $454,000 out of pocket. Her initial $94,000 plus $1,000 a month for 360 months. The remaining roughly $4 million, nearly 90% of the final balance, came entirely from compounding. Her actual contributions represent a small fraction of the outcome. That ratio deserves a moment. She did not earn $4 million. She created the conditions for $4 million to accumulate, and then she stayed out of the way. This is where the Monthly Accelerator earns its name. It's not just adding money to a portfolio. It's systematically deploying capital in a way that turns market downturns into accelerants rather than setbacks. Every dip means her monthly $1,000 buys more shares than it would have otherwise. Every recovery lifts a larger share count. The volatility that sends most investors running is the same volatility that makes this approach increasingly effective over time. One practical note worth mentioning: the automation piece is not optional. The research on this is consistent. Investors who manually execute regular contributions skip them at precisely the wrong moments. When markets are down, the human instinct is to pause. Automation removes that option. Set the transfer, attach it to your paycheck cycle if you can, and treat it as a fixed expense rather than a discretionary choice. The discipline is built into the structure, not into your willpower. 3 engines now. Each one is working. But there's a version of this where the goal shifts entirely, where instead of watching a number grow on a screen, your portfolio starts sending you a paycheck, a real one, every single quarter, growing larger each year without you adding anything new. That's what dividend growth, the income machine, actually looks like in practice. Retirement math has a flaw that almost nobody talks about. The entire framework, save a large enough number, then slowly withdraw from it until you die, is built around one uncomfortable assumption: that you will spend your final decades carefully rationing a shrinking pile of money, hoping you don't outlive it. That's the model. And for most people, it's the only model they've ever been shown. There is a different way to think about this. Instead of building a number you withdraw from, you build a machine that pays you permanently, without the balance ever needing to go to zero, because you're not touching the balance at all. You're living on what the machine generates. That's the income machine. And the engine that drives it is something called dividend growth investing. Here's the distinction that matters. A standard dividend investor looks for yield, the percentage of the stock price paid out as a dividend annually. A dividend growth investor looks for something more specific. They want companies with a long, documented history of increasing that dividend payment every single year, regardless of market conditions. Not just paying a dividend, raising it consistently, often for decades. Why does that distinction matter so much? Because of what it implies about the underlying business. A company that has raised its dividend for 20 or 30 consecutive years has survived recessions, rate cycles, inflation spikes, and industry disruptions, and still found a way to pay shareholders more each year than the year before. That track record is a signal. It tells you the business generates reliable, growing cash flow. It tells you management is committed to returning that cash to shareholders. And it tells you the dividend isn't a marketing gimmick that disappears the moment conditions get difficult. There is a group of companies formerly known as dividend aristocrats, S&P 500 members that have raised their dividends for at least 25 consecutive years. As of 2026, there are around 65 of them. Names like Johnson & Johnson, Coca-Cola, and Colgate-Palmolive. Businesses have been compounding their shareholder payouts through every major economic disruption of the past 3 decades. Now let's watch what this looks like in practice. Consider a financial analyst in his late 30s. He puts $94,000 into a 2-part portfolio, NOBL, the ProShares S&P 500 Dividend Aristocrats ETF, which holds a diversified basket of those elite dividend growers, alongside a position in a large-cap technology company with a strong and rising dividend history. He enables dividend reinvestment in the early years to accelerate accumulation, and then he holds. What he's watching isn't primarily the portfolio balance. He's watching the annual income the portfolio generates. After 10 years, that income stream is a meaningful supplement, several $1,000s a year arriving without him selling a single share. By year 20, it has grown into something that resembles a part-time salary. By year 30, the annual dividend income from that original $94,000 investment has reached approximately $280,000 per year. Read that again, slowly, on $280,000 a year in passive income, from an initial investment that, 30 years earlier, represented less than a year's salary for most professionals in this audience. He didn't sell anything to generate that income. The principle is still there. The machine is simply running, producing cash, and depositing it into his account every quarter, larger each year than the year before. This is what makes the income machine structurally different from every other approach. The other engines build net worth. This one builds cash flow, and cash flow has a quality that net worth doesn't. You can spend it without dismantling what created it. It funds a retirement, covers a child's education, seeds a new business, or simply accumulates further. The options multiply because the source never depletes. And here's what that really means in human terms. You stop making decisions from scarcity. The question shifts from, how long will this money last, to, what do I actually want to do with this income? That is a fundamentally different relationship with money than the one most people spend their entire careers working toward. 4 engines. Each one is capable of moving the needle on its own. But the reason wealthy investors consistently pull ahead isn't that they picked the best one. It's that they understood what happens when all 4 run at the same time. And that's exactly what the combined system makes possible. There is a version of this where you pick the best engine, run it well, and end up with a solid outcome, a genuinely good outcome. And for most people, that would already represent a significant improvement over what they're currently doing. But there's a different question worth asking. Not which engine works best in isolation, but what happens to the math when none of them are running alone? The answer changes the picture considerably. Think about what each engine actually contributes. The Snowball Effect provides automated, self-reinforcing growth from income that's already being generated. The Silent Force provides the raw amplification of time, the compounding base that expands with every passing year. The Monthly Accelerator provides systematic capital deployment that turns market volatility into a structural advantage. And the Income Machine provides a growing cash flow stream that doesn't require you to liquidate anything to access it. Each one addresses a different dimension of the problem. Automation, time, consistency, income. Running just one means leaving the other 3 dimensions largely unaddressed. Running all four means they start reinforcing each other in ways that individual engines simply cannot replicate. Here's a concrete way to see it. The dividend reinvestment from Engine 1 increases your share count. A higher share count means your monthly contributions in Engine 3 buy into a larger base. A larger base means the dividend growth in Engine 4 generates more income per year, more income reinvested over a longer time. Horizon means Engine 2, time in the market, is compounding a progressively larger number with every passing year. Each engine feeds the others. The system accelerates not linearly, but exponentially, because the inputs themselves are growing. This is why the gap between a one-engine investor and a four-engine investor isn't just meaningful, it can be generational. Not in the abstract sense, in the literal sense. The difference in outcomes can be large enough to change what your children inherit, what choices your family has, and what financial position the next generation starts from. Now, there is one more layer to this, and it's the one that most financial content glosses over, probably because it's less exciting to talk about than investment strategy. It's taxes. Every dollar of growth inside a taxable brokerage account is subject to capital gains tax when you sell, and dividend income is taxed in the year it's received. Over 30 years, that drag is not trivial. Depending on your tax bracket and the composition of your portfolio, taxes can consume a meaningful percentage of your total compounding gains, money that, inside a tax-advantaged account, would have kept working for you instead. In the United States, the two primary vehicles for this are the Roth IRA and the traditional IRA. The Roth IRA is particularly powerful in this context. You contribute after-tax dollars, the money grows completely tax-free, and qualified withdrawals in retirement are also tax-free. As of 2026, the annual contribution limit for a Roth IRA sits at $7,000, or $8,000 if you're 50 or older. It's not a large number relative to the balances we've been discussing, but the compounding advantage of tax-free growth over 30 years is substantial. Estimates consistently suggest that the tax-free status of a Roth IRA can add the equivalent of several additional years of returns, compared to the same portfolio held in a taxable account. If you're in Canada, the equivalent vehicle is the TFSA, the tax-free savings account. Same core principle. Growth and withdrawals are tax-free. The contribution room accumulates annually. So here is what actually putting this system together looks like. First, log into your brokerage and enable DRIP across your dividend-paying holdings. That activates Engine 1. Second, set up an automatic monthly transfer into your portfolio, whatever amount is realistic and sustainable for your current income. That activates Engine 3. Third, make sure a meaningful portion of your holdings includes companies or funds with a documented history of annual dividend increases. That activates Engine 4. And Engine 2, time in the market, activates the moment you begin and compounds with every year you stay. Do all of this inside a Roth IRA if your income qualifies. That's the structure that lets all four engines run without the tax drag slowly eroding what they built. The whole setup can realistically be completed in a single afternoon. One account, four engines, one structure that protects the gains. What comes after that is simply time. And by now you understand exactly what time is worth. Here is what this all comes down to. Compounding was never one thing. It was always a system. Four distinct mechanisms that most investors access partially, accidentally, or not at all. The feeling that your money should be growing faster than it is, that feeling is usually correct. The gap isn't effort, it's architecture. A few things are worth carrying forward. Reinvested income compounds faster than cash sitting idle. Time amplifies every other input, which means starting matters more than optimizing. Consistency beats timing every single time. And a growing income stream is structurally different from a growing balance, because you can spend one without dismantling the other. The question worth sitting with now is this. Which of these engines are you actually running? Not in theory. In your account, today, with your current settings. If this reframes how you think about your portfolio, share it with someone who's been investing on autopilot without fully understanding what they're leaving on the table. And if you want to keep pulling on this thread, there's a related question that doesn't get enough attention. Once the machine is running, how do you protect what it builds from the forces specifically designed to erode it? That's worth understanding before you assume the hard part is over.